HDFC Bank, the crown jewel of Indian banking and a staple in almost every investor's portfolio. But lately, it's been a rough ride for this private sector major. Since hitting its 52-week high in December last year, the stock has tumbled nearly 10% as of February 27, leaving investors questioning what went wrong. For a bank that holds 12.24% weightage in Nifty 50 and a massive 27.63% in Bank Nifty, its influence on the market is undeniable. But after its much talked about merger with HDFC Ltd, the once mighty banking giant has lost some of its shine, a trend we often see with many merger and acquisition strategies. But that hasn't gone down well with investors. There were concerns regarding the slowing loan growth, higher loan to deposit ratio, uncertainty on net interest margin improvement, and the overall health of the bank. While HDFC Bank's full return to its glory of the past is still some quarters away, there are telltale signs that the bank is moving in the right direction, and that's good news for investors. Welcome to Bottom Line. I'm Radhika Bajaj. In today's episode, we break down how and why things are looking up for the private sector banking giant, HDFC Bank. So be sure to hit that subscribe button. Let's try to understand why the bank had issues in the first place. HDFC Bank's shares had been underperforming even before the merger, possibly due to higher valuations. On a CAGR basis, the stock delivered a return of 8.2% from January 2021 to June 2023. However, in absolute terms, the return during this period stood at around 22%. Then, in July 2023, HDFC Bank Limited and HDFC Limited, the housing finance company, officially merged. For all practical purposes, financial and business growth, the merger made perfect sense. While on the one hand, it made the bank bigger, on the other hand, it brought in additional challenges, especially to the bank's balance sheet, as it took on both assets and liabilities of HDFC Limited. To give you context, HDFC Bank's high-cost borrowings were just 8% of its liabilities before the merger. Post-merger, these accounted for 21%. These are the liabilities that the bank raises via deposits and must be paid back to depositors. That means extra stress on its loan-to-deposit ratio, cost of funds, pressure on net interest margin, loan book, and so on. As such, 2 years after the merger, the stock remains subdued, delivering a return of around 2.5% CAGR between July 2023 and February 2025. We have seen how the price trend has been so far. But what does the chart tell us? While the broader market indices have been weak for the last 6 months, the HDFC Bank stock has given positive returns of around 3%. The relative strength is clearly visible. Along with this, even if we look at the weekly chart of HDFC Bank, the stock is trading above the confluence price band of 1586 to 1614. The confluence level is basically a price band from where the stock changes directly multiple times in the past, and it holds importance from a technical analysis point of view. This clearly highlights, based on the characteristics of price action, that since the start of 2024, the stock has been on an uptrend, making higher highs and higher lows. There is less probability of weakness until the level of 1586 is not breached on a weekly closing basis. Technical analysis aside, what do the fundamentals of HDFC Bank tell us? How is the bank's performance expected going forward? Well, to ensure stability, HDFC Bank has adopted a few strategies and they are working. Number one, slowing down loan growth. HDFC Bank has long been known for its consistent loan growth. In fact, for years, it was almost a given. The bank would expand its loan book by around 20% annually. But in Q2 FY25, loan growth slowed to just 7% year on year, slipping into single digits for the first time in many years. The slowdown didn't stop there. In Q3 FY25, growth dropped even further to a mere 3% year-on-year. At first glance, this decline might seem alarming. After all, HDFC Bank is a heavyweight in India's financial system. But this was a deliberate move by the bank's management and therefore should not be seen as a concern. In its Q2 FY25 earnings call, the bank outlined a carefully planned strategy for the growth of the bank. The management stated that for FY25, loan growth would be lower than system level growth. By FY26, it would be in line with the system. And by FY27, HDFC Bank would outpace the industry. This same message was reinforced in the Q3 FY25 earnings call as well. So why is HDFC Bank intentionally slowing down its loan growth? Well, to improve its loan to deposit ratio or credit to deposit ratio. The loan to deposit ratio represents the percentage of loans issued by a bank in relation to its total deposits. Let's take an example. If a bank has an LDR of 120%, it means it is lending 120 rupees for every 100 rupees in deposits. This can pose as a liquidity risk by leaving fewer reserves for withdrawals. Usually, an LDR of more than 100% isn't always a good sign. HDFC Bank's LDR spiked over 100% post the merger with HDFC Ltd on account of the high cost deposits it inherited. As of Q3 FY24, the LDR stood at 110.5%, well above comfortable levels. This was a concern as excessive lending without sufficient deposits can strain the bank's liquidity position. To alleviate this concern, HDFC Bank strategically slowed down its loan growth and brought the LDR under control. By Q3 FY25, the bank had successfully reduced its LDR to 98.2%. Now, going forward, HDFC Bank's goal is looking to bring the LDR back to its pre-merger levels of the mid-80% range. Number 2, growing deposits. HDFC Bank is making a strong push to expand its granular deposit base, a cheaper and more stable funding source compared to borrowings. To achieve this, the bank has been aggressively expanding its branch network. Since the merger, HDFC Bank has consistently added new branches each quarter, 241 in Q2 FY25 and another 51 in Q3 FY25. This expansion strategy is already showing results. Deposits have grown by 15.9% year-on-year in Q3 FY25, outpacing the industry average. As mentioned, the ultimate goal is to reduce the loan to deposit ratio or LDR to pre-merger levels of mid-80%, optimize operating costs and stabilize margins. This apart, HDFC Bank has been actively integrating its branch network post the merger. As of now, over 80% of HDFC Bank's branches are equipped to service accounts from the merged entity. In the last 12 months, the bank has added over 1,000 new branches, expanding its network by 13% year-on-year. Interestingly, nearly 38% of these branches are less than 3 years old, meaning productivity gains are expected in the coming years. As per news report, insights from research houses such as Nomura suggest that when an HDFC Bank branch completes 10 years, it reaches an inflection point leading to a surge in deposits. One common theory is that banking customers prefer the status quo. It takes time for a branch to gain trust and establish itself within a local community. But once that trust is built, deposit inflows can accelerate significantly. Currently, over 2,000 HDFC Bank branches are in the 5 to 10 year age bracket. The bank is betting that many of these will soon hit their J curve, unlocking a wave of deposit growth. Beyond branch expansion, HDFC Bank is also working to convert former HDFC Ltd customers into full-fledged bank customers. Of the 4 million mortgage customers from HDFC Ltd before the merger, 1.9 million have already opened deposit accounts with the bank. HDFC Bank is further deepening its relationship with these customers through cross-selling retail products. So far, 250,000 converted customers have been issued additional products like credit cards, marking the beginning of a larger effort to increase the wallet share. While term deposit growth was strong, increasing 15.9% year-on-year and 4.2% quarter-on-quarter in Q3 FY25, low-cost CASA or current account savings account deposits grew at a much slower pace, just 4.4% year-on-year, and even declined 1.2% quarter-on-quarter. As a result, HDFC Bank's CASA ratio now stands at 34% in Q3 FY25, down from 37.7% in Q3 FY24, the first quarter post-merger. So why is CASA important for banks? Well, CASA deposits are cheap money that banks raise from depositors. That is typically Banks pay around 2.5 to 4% as interest for CASA deposits, which is lower than term deposit rates of 6 to 7%. That's why it is important for banks to grow their CASA book deposits along with term deposits to balance out their cost of funds. However, this slower CASA deposit collection trend is not just an HDFC Bank issue. Liquidity tightness in the system has impacted CASA growth across private banks, with Axis Bank and Kotak Mahindra Bank reporting even lower year-on-year growth in the December quarter of FY25. Number 3, stable cost of funds and net interest margins. HDFC Bank has managed to keep its cost of funds stable at 4.9% for the past few quarters till the December quarter of 2024. The net interest margin, a key metric, has also remained stable in the past few quarters at about 3.4%. Now, this is mainly thanks to a loan mix with higher yields and a stable cost of funds. This apart, the bank, as part of its strategy, has been retiring high-cost borrowings inherited from HDFC Ltd whenever the opportunity arises. Now, one of the ways the bank has been doing this is through the securitization of car loans. In September 2024, HDFC Bank securitized over 9,000 crore rupee worth of car loans. In November 2024, it completed another 12,300 crore rupee securitization of similar loans. Now, these loans have been rated AAA by India Ratings and Research, indicating high quality. This helps HDFC Bank in improving liquidity, freeing up cash that the bank can use for other purposes such as expanding its branch network or new growth avenues. Also, offloading these loans from the bank's book brings down the LDR. As mentioned earlier, the bank has brought down its LDR to 98.2%, marking significant progress towards its goal of returning to the mid-80% range seen before the merger. However, the key downside of loan securitization is that when HDFC Bank sells these loans, it forgoes future interest income that it would have earned over the life of the loan. Instead of receiving steady interest payments over the years, the bank gets a one-time lump sum payment from investors. While this provides short-term flexibility, it also means the bank will need to actively reinvest that capital into other high-yielding opportunities to maintain long-term profitability. Moreover, given the current deposit mix where term deposits have grown significantly while low-cost CASA deposits remain sluggish, analysts are of the view that full normalization of funding costs could still take some time. That said, these measures have helped in keeping the net interest margins and cost of funds stable in the past few quarters. Number 4, asset quality is in good shape. The gross NPA ratio saw a slight increase, rising to 1.36% in Q3 FY25 from 1.33% in Q2 FY25. Slippages on an absolute basis grew 12.8% quarter on quarter, primarily due to seasonal factors in the bank's agricultural loan portfolio. Slippages, by the way, is a term used when there are new loans that have become non-performing assets or NPAs for banks. However, aside from the agricultural segment, all other loan categories, including retail, secured and unsecured portfolios, remain stable. The bank's management has indicated that they do not foresee any significant stress emerging across its loan book. This positions HDFC Bank differently from some of its peers quarter on quarter. For instance, Axis Bank's Q3 FY25 gross NPA was at 1.46%, slightly higher than its previous quarter of 1.44%. A similar case is that of Kotak Mahindra Bank. Its Q3 FY25 gross NPA rose to 1.50 from 1.49% in the previous quarter. So what's the big takeaway? The post-merger hurdles, from higher borrowing costs and an elevated LDR to rising operational expenses, are finally easing. Now that the interest rates have started to ease, the growth plans the bank has charted should work in its favor. Also, the early signs of merger synergies are kicking in, and this sets the stage for the strong growth of HDFC Bank in the coming years. Do you have HDFC Bank in your portfolio? If yes, let us know your thoughts in the comments.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.